Good morning. We're here live from the Light Space. I have Ahron with me today. So Ahron joined our team at the end of April to help with various projects that we have for our clients. And we are super excited. Ahron, can you tell us a little bit about your background?
Yeah, sure. So I was in the technology sector, I guess. I worked for a technology company for about 15 years in kind of various financial leadership roles. And did a lot with manufacturing, did a lot with some consulting services and other stuff, so project-based accounting. So I have a lot of experience on kind of the tech side and kind of high growth, fast-paced companies. So
I love this story. We had an advertisement out for a part-time accounting coordinator, and Ahron applied, and we're like, what's going on here? His experience is well beyond that skill set, but we are so thankful that he is available to us when we need him, when we got big projects and need to hammer those out. But today we're going to talk about investments and investing in the market. So one of Ahron's hobbies is that what we're calling it?
yeah, I guess it's more of a part-time job now.
Yeah, part-time, or one of his side gigs or part-time jobs is to monitor the market. So from when he wakes up in the morning till about 10:30, he's doing some analysis, and much better at that stuff than I. So Ahron, you want to just talk about what your expertise is, or what you kind of do with that?
So I've been trading stocks for probably almost 20 years now. So I started an E-Trade account when I graduated from high school. And one of my first trades ever was buying Amazon back for when it was like $18 a share. And I sold it for like $26 a share and thought I was a genius at the time, because I made a 50% return almost in a couple weeks. Had I held on to that, it'd be worth like $500,000 today. But it really got me excited about trading. So I've been doing it kind of off and on for, like I said, about 20 years. And more recently as more of a part-time, full-time gig, managing my own portfolio, managing my 401k, IRAs, things like that. So and I just really like analysis. I like looking at financials. I like understanding what drives the markets. So it's been a really fun kind of outlet for me lately, and something I really enjoy.
Yeah. Can you tell us like the basic behaviors of the market, so that when people, I know when I open my Q1 401k, I'm like, okay, there goes 25% of what I've put away. But
yeah, and lately it's been really hectic. I mean, the markets have been acting a little bit erratic. Obviously, COVID-19 was a big shock for everyone. I think initially, if you go back to late last year, there wasn't much thought given to it. It was more of something that was not in the U.S. at that time, and the markets weren't really doing much with it. But you get to late February, when it became more real, some of the states started locking down. There was more attention given to it from the federal government and the Fed, and the markets really responded negatively to that. And why that happens, a lot of times the markets are trying to look at the future and predict what's going to happen, and they're based on a set of assumptions. So anytime you get something that goes counter to the assumptions they've built, it changes the market.
Okay.
And this is obviously a big kind of once in a lifetime event that really hit the market, and we lost 30+% in most cases. But what we've seen is kind of this breakout where there's kind of winners and losers in the markets today. And most people's 401ks, IRAs, they're in mutual funds, index funds that basically track the market.
Yeah.
But there's companies like Amazon, like Walmart, like Facebook, that have done really well in this market because the stay-at-home economy is kind of catered to what they do, whereas some of the manufacturing sectors have really been hammered because they've had plants that have shut down. Not a lot of people buying cars or appliances right now. So you have the segmentation of the market where you really have winners and losers, and because most people's investments are in these index funds that track the broader market, you see this downward trend and more recently a slightly upward trend that's kind of bringing back with the market. So when you get into this, I'm not certainly advocating that everybody start buying stocks individually, picking stocks, because index funds and mutual funds in the long term will return to the levels they were at, but it just takes time, and these kind of disruptions really spook people a little bit. And I'm here to say it's nothing to worry about. You know, over the last 100 years, the stock market has gained 7% a year. You know, it's just over what period of time you're looking at it. So.
Yeah. So, is there any way to kind of, or what should people? So let's take a couple different scenarios. So people like me in mid-30s. How do I respond, or do I respond in this situation, or what do I do?
Yeah, and it kind of depends on what your plan is, and I think this is probably the big message for everyone. Really have a plan, like what you're trying to accomplish with your retirement savings. I had one guy that told me that you should treat it like a job, because it's really, you know, you're making money, it's building for your retirement. You should treat it like a job. So spend time, you know, every week, every month, looking at markets, understanding the terminology so it's not as scary for you.
Yeah.
And then, you know, really focus on having that plan so that when you make adjustments to your portfolio or your investments, that you do it with an intent, you know.
Yeah.
And, you know, for younger people, anyone under the age of, say, 50, you really don't need to be too concerned about this. I mean, it's an opportunity a lot of times if you have additional funds. I know that's tough right now with a lot of people out of work and stuff like that, but if you have additional funds, when the markets are down, it's a great time to buy into them.
Yeah.
Because like I said, they will return. It just will take time, and now you can buy them at a discounted price.
Yep.
If you don't, and you just have your money in the markets, you know, there's really, after it happened, there wasn't much you can do about it. I mean, to sell it at the low would be a little silly. And now that it's starting to recover, you know, now maybe is the time you can relook at your portfolio and start to reallocate things to things that make sense to your investment strategy.
How about if you're a little bit older, closer to retirement? Is this like a 2008 or 2001 kind of scare where, oh, I now have to work for 5 more years, or?
Yeah, I mean, hopefully not. I mean, the thing with the pandemic is, you know, it's going to impact our lives probably. I mean, most people are saying for 2 years or more before the markets fully recover. But it also is something that it's less, it doesn't stick as much as like a recession did. It took almost 6-7 years for the markets to recover from the 08-09 crisis. This should be faster, but it's not going to be, you know, the V-shaped curve they talk about a lot where, you know, markets go down and come right back up. It's probably going to be a slower slope on the upside.
Like a U?
Yeah, like a U, just because there's still so much uncertainty with what's going to happen. Until the vaccine is out there, until, you know, we get back to kind of business as usual to some extent, and people see what the next wave of this pandemic is going to look like, markets are going to continue to be a little bit erratic. So if you're closer to retirement, you know, hopefully before this happened, you had some strategy and have started to move, you know, some of your investments into safer, more risk-free environment. But if you haven't, you know, I think again, this is probably going to be a 2 to 3 year thing where it's going to be a little bit erratic till we get back to those, you know, pre-COVID levels. So if you are close to retirement and you kind of want to look for some areas to do that, I mean, certainly looking at the blue chips that are paying out dividends is a good way to kind of amplify your returns a little bit, especially as you approach retirement. And look for, like I said, some of these tech stocks or some of the medical stocks you see every time someone has a new COVID test or a vaccine, that you get a nice bump. You know, we're going to see that continue. So some of those sectors really will be areas of positive movement over the next, you know, say year. But if you're, again, close to retirement, really understanding your plan at that point. If you don't need to take the money out, then don't. And continue to manage that portfolio until the market more fully recovers.
Okay. So what sectors, I know you mentioned a couple of them, technology and maybe even consumer goods are doing okay depending on where they sell. What are ones that are not doing as well?
Well,
manufacturing.
Yeah, there's a lot of them, but manufacturing certainly. We've seen a lot of on the healthcare side. We've seen a lot of kind of hit and miss. There's companies that have done really well, and companies that have really struggled. So I don't want to get too much into individual stocks, but I think in general, people that have embraced the stay-at-home economy, people that you know, again, tech is obviously a great example of that, where people can still use their products remotely, Zoom, things like that, that probably most people didn't even know about before this now is, you know, like a common language for everyday business and everyday interactions with your family. So there's a lot of those people that have really embraced that. People, you know, again, Amazon, it's easy. You don't have to go anywhere. They deliver it to your door. Walmart, similarly. You know, some of the retail companies that have really embraced the in-store pickup or curbside pickup have done well through this, or have not performed as poorly as some of their peers. So, you know, it's really, if you understand the economics of, you know, what are people buying right now, and I think in previous stimulus packages, what we saw was a lot of durable goods, they call it, where we're talking about like appliances and cars and things with a longer life. Were really hot sectors caused by the stimulus, but this has been more consumer goods and things like that people are buying, paying rent, paying for you know, home repairs, like the Home Depots of the world have done surprisingly well through this.
I was gonna say, those stores.
So there's, you know, again, it's companies that have done well adjusting to this that have really shown positive movement, whereas some of them that didn't have struggled.
That makes sense. So what I hear you saying, and maybe was there a very not intentional, but like a direct impact that you saw, because you're looking at the markets every day, from like the day or approximate time of either the PPP funds going out or the individual stimulus checks that go out, and a recovery in the market? Was it that dramatic that you could just see it?
Yeah, it probably wasn't as dramatic as you might expect, because, like I said, the market's really priced in these assumptions. So once the bill was announced, the 1.8 trillion or whatever it was announced, you really saw the impact there. That's when we saw the pretty big days of recovery that kind of brought us to our current levels. And then since then, it's kind of been, you know, bouncing up and down day to day. There's talk of another stimulus package. Every time a new vaccine trial or something goes out there, we see that. And again, that's all stuff that is kind of breaking the assumptions of, you know, that this recovery is going to take 12 to 18 months. If a vaccine comes out sooner is available, you know, we will see the market respond positively to that. If Congress passes another stimulus bill, we'll see the markets respond positively to that. So you may not see it when it actually goes into place, but you'll see it ahead of time when the market kind of prices that activity into the markets.
So it's not as much direct in supply and demand as like assuming we know what the supply and demand is going to be.
Exactly. I mean, it's supply and demand of these stocks, you know, and the more people have confidence in the stocks, the more they'll buy those in anticipation that they'll perform well. It's surprising, and this is the thing that gets frustrating for a lot of investors who are starting out, is how disconnected Wall Street is from quote unquote Main Street. You know, financial performance, you know, Amazon or someone will beat estimates by, you know, 10% or something, and the market will not even move the stock. And a lot of times it's because it was already priced in. Because you have these analysts who are working with the leadership at these companies every day. They know what to expect. They've already priced in that they're going to do well. And so, and again, sometimes there's surprises there, and that does push stocks, but in general, these analysts, again, they're dealing with this every day. And that's why I say, you know, picking individual stocks is a bit of gambling for the average investor, because there's just so much that we don't know. By the time you see it on Google, or by the time you see, you know, an article about it, people have known about it for weeks, if not months, in the inner circles. So it's hard to do that as an investor, to pick individual stocks. Now, you can follow the analysts and follow, you know, what people are doing with stocks, and that will, you know, you may not catch the exact upside or the exact downside, but you will, in general, perform better than just, you know, having an index fund or having a mutual fund holding your investments. So.
Okay, that makes a lot of sense. If you guys have any questions, comment below, and we'll gather those and let Ahron reach out to you too.
Yeah. Try to answer
them. Try to answer them. So we appreciate those watching and those that will watch. Do you have any other closing comments, Ahron, on what we could expect maybe in the next 90 days? I know you can't predict the future, nobody can, but
yeah, I think we're going to see a lot of this continued volatility. The Fed lately has been talking again about lowering rates. If they do that, that probably we won't see that for another couple months, but that will drive the markets up.
okay.
Right now, inflation is going to be really low, so I think there will be some incentive for them to drive that rate down. We're seeing credit markets tighten a lot. So the Fed recently started investing in ETFs, and I won't get into a long discussion about that, but corporate bond tracked ETFs. So they're going to bring some liquidity to the corporate bond markets, which will help companies who need money access those funds. So I think that'll continue to prop up the bond markets and hopefully prop up some of the stocks. So I think the biggest thing that I think is going to scare people is if, as we reopen the economy, if we see a lot of these, continued breakouts in large areas. If we have to kind of pull back on the reopen, that's going to negatively impact the market. I could see a 5% downside there or something. But in general, I think we should continue to see volatility. The market should be fairly stable in terms of the price, but you'll see some up and down movement week to week. But as we start to get more information about, is there another stimulus package? How are these reopenings going? We'll start to see the market respond to that. So I'm still, ultimately bullish on the markets long term. They will go up. It's just unfortunate that we don't all know the timing. So
right.
If we did, it would be really easy.
Then we'd all be retired.
Yeah, exactly. So if you have 401ks, IRAs out there, again, index funds maybe start to look to diversify that a little bit, because we're going to see those winners and losers in some of the indexes. You're going to see kind of a muted gain there. So maybe look at trying to invest in more targeted mutual funds that are more for sectors or ETFs. I like ETFs because they're cheap in terms of trading or management fees. So looking at things to diversify your portfolio, looking at companies that are paying dividends, some of those things will help continue to prop up your returns, even though the market may not be moving as much to really show it in your broader portfolio. So.
All right, have we missed the boat? Say that I have a small chunk of money that is sitting in the bank, not earning any interest. Is it still low enough to where I should buy, or is it? There's no answer to that. Right?
Again, I got to be careful. I'm not a certified financial planner or advisor here, but it really again goes back to your strategy
and your risk tolerance.
Because you never know what's going to happen. Even analysts that do this every day don't know what's going to happen with the market. There's some concern that a recession is coming, that prices have been overheated in the stock market. We'll see if Fed policy will have a lot to do with what happens there. So I wouldn't say it's too late, but I think, again, you need to understand your risk tolerance, what you're trying to accomplish with that money, because it's not gaining anything right now. But if you lose it, it's obviously not helping either.
Right.
So, I would encourage anybody, especially if you're younger, putting money into savings, into investments is always a good option. Again, if you're young, we saw 08, 09, and it recovered and exceeded that by quite a bit. We saw the same thing back in the dot-com bubble. So again, the markets will recover. So I don't think it's too late to buy in, but you just got to be careful, I think, more now than ever where you're putting that money. So that we don't end up with some of those companies that maybe have struggled through the stay-at-home economy a little bit. So
makes a lot of sense. All right, well, thank you, Ahron, for your time today, and thanks for joining us. Like I said, if you have any questions, shoot us a note or a comment, and we'll see you soon.